Hello, everybody, and welcome to our live webinar today, New Tax Legislation Impacting Tax Returns in 2022. We're excited that you're here because we have a lot of information to cover and prepare you for next year's tax season. Some of the topics that we're going to cover today are hot topics that you as tax professionals need to keep top of mind as you get ready to receive customers for next year's tax season, and of course to stay informed as you continue to talk to your tax clients and they continue to seek advice from you. So let me introduce our panelists for today. We have Mark Luscombe and Michael Hennigan from your Wolters Kluwer Tax and Accounting North America team. Thank you so much for joining us today, Mark and Michael. I'm gonna give you a few minutes to introduce yourselves for those of you who are not familiar with what you do and some of the content that you put out there regularly for Wolters Kluwer. Mark, let's start with you.
Thank you, Luis. So my title is Principal Analyst for Wolters Kluwer Tax and Accounting, and I've been with Wolters Kluwer over 25 years now. So my principal job actually is media related, covering a lot of media inquiries. I do a lot of work with new tax developments and tax legislation. And I also do a regular column for Accounting Today and Taxes Magazine. And always look forward to these years where we get lots of proposed tax legislation and hope that something will actually get enacted. Michael?
Hi, everyone. My name is Michael Hennigan. I'm the managing editor. I'm a managing editor in the editorial group at Wolters Kluwer. I am the managing editor of the U.S. Master Tax Guide and also Tax Prep Partner, which is available on Answer Connect, on CCH Answer Connect. And I am also the coordinator of the legislative team. So when we, like Mark said, when we do get busy with legislation, I am responsible for our coverage on that as well. So I guess I look forward to when we have legislation. It's something to do, but it's a lot of work. So,
we certainly do love these types of years where there's a lot going on in Washington, a lot of tax laws, and in a way that brings a lot of business to tax professionals. So that's always welcomed. So let's take care of a few housekeeping items here. Questions will be submitted in the questions tab in your GoToWebinar screen. Anything that you send to us from that questions tab will be submitted privately to myself, Michael, and Mark. We'll be doing a Q&A session part of the presentation at the end. So go ahead and submit your questions. We're gonna keep reading them. And then as we get closer to the end of the presentation and we cover all the content that we have prepared, then we'll go into the live Q&A. Now, everybody that registered will receive a link to watch the recording session of this webinar tomorrow. So within 24 hours, you'll receive that email, click it, you can replay and rewatch as many times as you'd like. This session is eligible for continuing education credits. It's 1 CE and 1 CPE credit, but you must be logged in for the next 50 minutes and answer all the polling questions that we have. It's about 4 polling questions today. You must answer at least 3 to be eligible to receive the CE credits. IRS CE credits will be issued within 14 days and entered directly into your IRS PTIN account, and your certificates of completion will be made available for printing and downloading within 14 days. All right, so that's your housekeeping items. Mark, Michael, there's a lot of information to cover today. Why don't you give us a high-level overview of the content that we've prepared for this session?
Sure, thank you, Luis. So, as you've seen with this recent tax legislation, we've got a lot going on that goes on during the year. So if you've been focused on just doing compliance, now I'm sure you're feeling like you've become much more of an advisor to your clients. You've had to become an expert on PPP loans and PPP loan forgiveness. You've had to become an expert on economic impact payments during the year, and now this year we have not only economic impact payments, we have refunds of unemployment compensation exclusions, and we have advanced payments of the child tax credit. So there's a lot new for 2021, and that will affect the 2022 filing season. but you're not going to be able to put it all off until next January. You've got a lot of issues to deal with and talk to your clients about this year. So we'll get into those issues in the new legislation, primarily from the American Rescue Plan Act. And then we will also get into what's being talked about for the rest of the year that could also perhaps impact 2021, but more likely impact 2022 and later years with some possible provisions retroactive. Let's move on now to the child tax credit. So the child tax credit has been around for a long time and a lot of changes going on for 2021. But by and large, the child tax credit is not going to benefit a lot more people that it didn't benefit before. This is going to be more generous. And that's only, the changes are for 2021 only. So it's fully refundable now, but it was already refundable up to $1,400. So that will not expand the scope of people a lot who get advantage of the credit. It might affect the amount they get. And expanding the age limit to 17-year-olds, but those people were already included when they were younger. So again, probably not increasing too many the taxpayers that it covers. So it did significantly increase the dollar amounts, but again, probably not increasing people covered. And then there is a new separate phase out for these increased amounts. But if you notice, the phase out is lower than the phase out for the original amounts. And those that original phase out between 200,000 for single filers and 400,000 for joint filers, that's still the phase out for those old lower limits. So actually the newer phase outs for the increased amounts are lower, and that does not increase the amount either. But the real thing I want to focus on for the child tax credit is these advance payments. So I'm sure you've already heard all the discussion last week about the advance payments coming out, and they continue through December 15th. So up to $300 per child up to age 6, and then the $250 per month for a child age 6 through 17. But the big issue with these is, unlike the economic impact payments, if you get too much in the advance payment, you do not get to keep it, which raises the possibility of considering opting out of the child tax credit, and that might be something that you'll want to discuss with your clients. So what are the reasons you might want to opt out? Well, if your income goes up in 2021 compared to 2020, which might be the case of a lot of people due to COVID, you might not be eligible for that based on your 2021 return, even though you might get an advance payment based on your 2020 return. So that might be one reason you opt out. Another reason might be a lot of separated couples alternate who claims the children every other year. So if you claimed a child in 2020 but are not claiming that child in 2021, you also might want to opt out of the advance payment. So just some things to think about. Now there are a couple of exceptions to the advance payment for some low-income people. They would not necessarily have to return all of the payments. So all of this is covered in various IRS portals, which are just starting to come out. The Child Tax Credit Update portal. So you can confirm your eligibility on the Child Update portal. It's called the Child Tax Credit Eligibility Assistant to help taxpayers determine whether they want to. There's a provision in the portal for opting out. It's obviously already too late to opt out of the July payment. And the deadline for opting out of the August payment is August 2nd. And there'd be a similar early month payments in September and on to opt out of subsequent payments. You can also update the bank account information on this portal. If the IRS doesn't have your bank account information for a direct deposit, you'll end up getting a check unless you want to get that direct deposit information to the IRS. There's going to be other things you can do soon on that portal. They aren't quite up there yet. check on the status of a payment or update other information, such as reporting the birth of a child to try to increase the advance payments, or to report a change in income or filing status that might also affect the amount of your advance payment. The IRS will be sending letters confirming eligibility for these advance payments and the amount and the date they commence. So your clients should be getting letters, not only getting the deposit in the bank, but also a confirming letter. Okay, let's do the first polling question.
That's right, Mark. Let me go ahead and launch the first polling question for today. And remember, to be eligible to receive CE and CPE credits, we need you to answer all polling questions, with the first one for today being, which of the following is not a correct statement about the child tax credit for 2021? And let me remind you that these don't have to be answered correctly. It's just really for participation. Make sure that you stay engaged, that you're paying attention. That's all requirements for the CPE and CE credits. So choose the answer that, that to the best of your ability from the four provided. It is fully refundable. It has an increased age limit. It has an increased income phase out, or it provides for advance payments. And again, the question is, which of the following is not a correct statement about the child tax credit? Keyword there being is not a correct statement. We'll allow you to spend a couple of more seconds, thinking about your answer. We have 73% voted so far. We're looking for at least 90%. Remember, you have to answer these polling questions to ensure that you get your CE and CPE credits. And so far, Mark, we have 44% with the answer, it is fully refundable. Not final results yet, but that's what it's looking like so far. All right, let me go ahead and close the poll and then share the results out with everybody. We have 42%, it is fully refundable. 26%, it has an increased income phase out. 21%, it has an increased age limit. 11%, it provides for advance payment. So Mark, which of the following statements is not a correct statement about the child tax credit for 2021?
The 26% of the people got it right. It does not have an increased income phase out. The phase out for the additional credit is actually smaller than the phase out was for the original credit for prior years. And it had been partially refundable, but as of 2021, it is now fully refundable.
Great.
Okay, let's move on now to another provision from the rescue plan, the earned income tax credit. And this has some aspects that are for 2021 only and some permanent changes. And these changes do expand who's eligible for the earned income tax credit, primarily helping out people without children. So the age limit is increased. It goes down to 19 years rather than the limit at 25 years. The phase out percentage is increased, and you can use 2019 income instead of 2020 income if that would help out your earned income credit. So this change could really help out, for example, recent college grads who may be starting their first job and have a relatively low income. They may only be working part of the year because they were in school half of the year. So now those people could be eligible for the earned income tax credit, where they would not have been before unless they were old enough. Now there are some permanent changes also. So the allowing certain separated spouses to claim the credit as separate individuals, and allowing singles and couples who do not have Social Security numbers, who have Social Security numbers rather, to claim the credit even if their children do not. So a little expansion there. And then another significant permanent change is an increase in the investment income limit all the way up to $10,000. So that should really open it up to some people who may not have been eligible before. The Child Independent Care Credit also expands the eligibility of people from what it was before, although at the very high income level, it may actually restrict some people from eligibility. Under the old law, it phased down to 20% and then stayed at 20%. It never phased out. Under the new law, it phases out completely at $438,000. So some people at the high end may lose out on this credit, but at the lower end, a lot of more people will benefit because look at the phase out is now between 125,000 and 400,000, while the phase out used to start at 15,000. So a significant increase there. It's now fully refundable, and it was not before, so that will increase the number of people who are eligible at the lower end of the income spectrum. And also just an increase in the percentage limits and the amount. So on the whole, a much better availability of the Child Independent Care Credit. The employer provided dependent care assistance. That's the other tax piece available for dependent care. And if you use an expense for one, you cannot use it for the other. But this was stuck at $5,000 for many years, and the dollar limit has now been increased to $10,500, $5,250 for married filing separately. Though, as has always been the case, the employer must adopt the change, so it's not automatic. It's only if the employer provides it. The premium tax credit, part of the Affordable Care Act, which, by the way, I'm sure a lot of you have heard, survived another Supreme Court challenge. So it continues to be with us. So this one is for 2021 and 2022, and it expanded the threshold for those eligible up to 400% of the federal poverty level. And for 2021, it's applicable to taxpayers and includes whether income is the unemployment compensation. So they are eligible for the premium tax credit as well. So Michael, all these are primarily only available for 2021, but I think there's proposals out there that might hope to extend some of these. What hope do you see for these?
Well, it's going to be interesting to see because, and we're going to be talking about this a little bit later when we talk about legislation for the rest of the year. But the Biden administration, both through the American Families Plan, which they proposed a couple of months ago, and as we saw in their budget proposal and in the Treasury Green Book released back in May, they do talk about making a lot of these credits permanent, right? So what the proposals are, for instance, the premium tax credit, which we have right here, is making those increased amounts and those thresholds and the availability for people above 400% of the federal poverty line to claim the credit. They are talking about proposing making that permanent, right? Beyond that, we talked about the earned income tax credit, that expansion for childless workers that you talked about. That's something else that they want to make permanent. Same thing with the Child Independent Care Credit, right? It's the making those changes and that increased amount and the 50% credit amount, making that permanent for going forward in potential legislation. And then, of course, the big one that we talk about is the child tax credit. They aren't talking about making all of that permanent. They're talking about making that increased amount, the increased age, and the ability to advance the credit, not permanent, but extend it through 2025. But they do want to make the full refundability portion of that permanent forward. So it's going to be interesting to see how these things play out. Obviously, this is all very, very expensive from a revenue standpoint. So depending on how the legislation shakes out for the rest of the year, which, like I said, we'll be talking about a little bit more later. Taking over from Mark, some of the other things that were passed as part of the American Rescue Plan or other pieces of legislation are those recovery rebates. Now, there's not a ton you have to do with that now, right? I mean, a lot of those have been paid out already. If you remember, the requirements for getting a credit or for getting the economic impact payment were largely similar to what the one back in the spring of 2020 were, and the smaller one that was passed as part of the Consolidated Appropriations Act back in December. So the only big difference there is that this latest round included non-child dependents in the credit. There is talk of another round of these, not as much as there was, after the last two. There are some lawmakers that really, really like these, but nobody has made a serious proposal of that, and they aren't included in the budget proposal from the White House. The only thing you have to keep an eye on to make sure that people get what they actually are entitled to. The IRS has recently started sending out additional payments to cover the people because the original credit could be based on 2019 tax information if 2020 tax information wasn't yet available. Well, if the people have, since they got their payment, filed their 2020 taxes, and it turns out they were entitled to more, the IRS has started sending out, additional amounts to cover that. But otherwise, from a 2021 tax standpoint, these are credits against your 2021 taxes. So when the time comes to file, there is a line on the form to reflect how much of a credit you should have gotten. And you probably remember that from this past filing season because there was one on there for the 2020 payment as well. So charitable contributions were another thing that saw big changes in the last couple of years. If you remember back in last March's big tax legislation related to COVID, they included a $300 charitable deduction above the line, no income limitation, and you didn't have to itemize in order to get it, right? So they did extend that, not in the American Rescue Plan, but in the Consolidated Appropriations Act back in December. They extended that to 2021, but made a little tweak. They increased it so it could be $300 per taxpayer if you're a filer. So it could be $600 total for married filing jointly. But now it is not subtracted from adjusted gross income. It is subtracted in calculating adjusted gross income. It is after AGI is calculated, so it's a reduction against your taxable income. The spring 2020 legislation also increased the limits for individual itemized deductions to 100% of the contribution base. That was extended through to 2021. Now it looks like it's time for a polling question, Luis.
That's right. Thank you, Michael. Let me go ahead and launch the second polling question for today. And again, this is a requirement for your IRS CE and CPE credits. This is polling question 2 out of 4. And the question is, which of the following is a true statement about the charitable deductions for non-itemizers in 2021? Is it A, it is an above the line deduction before AGI. B, it is up to a $600 deduction for married filing jointly. C, eligibility is subject to an income phase out. Or D, qualifying donations may be in the form of cash or property. Again, these don't have to be right. It is simply to assess your participation during the session, make sure that you're here. as it is a requirement to be eligible to receive the CE and CPE credit. So we'll give everybody maybe 30 more seconds. I see that we're 54% voted. We're looking for at least 90%. So if you have not entered your polling question answer, please go ahead and do so. And so far, Mark, Michael, it seems like the two top answers are the ones that seem to resonate with most people. We have 80% so far. It is up to a 600 deduction for merit filing jointly. And then 20%, it is an above the line deduction before AGI. So we'll go ahead and close the poll right now, share the results out with everybody. And Mark, Michael, is that what you were expecting as far as answers?
Yeah, the second answer there is the correct answer. It is up to a $600 deduction for merit filing. The above the line deduction was only in 2020. In 2021, it is not an above the line deduction. So, good job, everyone.
That's right, great.
All right, next up, we have the unemployment compensation exclusion. Now, this was something that was passed as part of the American Rescue Plan. It allowed for the exclusion of up to $10,200 of unemployment compensation for taxpayers with modified adjusted gross income below $150,000. Again, not a lot to do here for 2021. You know, the only thing to watch out for is, you know, because that legislation was so late in the spring, it was towards the end of March. A lot of people had already filed their returns and may have included that income, that unemployment compensation in their income. So the IRS was going to not require people to file refunds. It was going to go through and find all those people and you know, send refunds to them proactively. And they have been doing that. So the one thing you have to watch out for during this year, and as you get into filing season next year, is to just make sure that, you know, your clients got the proper amount back if they were entitled to get something. The next item is the COBRA continuation coverage. So what this was, it allowed for a 100% employee subsidy for employees or former employees who were paying for COBRA and continuation coverage during that period, April 1st through September 30th. That reduction, basically, the basic idea was they just would stop paying for their coverage, right? That reduction is excluded from taxable income from that, so it's not like other forgiven payments that, you know, are included in income. The credit is actually, it's paid, it's the subsidy is in the form of a credit that actually gets paid to, that is actually claimed by the former employer, whoever the payments, the COBRA continuation payments are going, as a credit against the Medicare tax. So it could apply to an employer terminated or with reduced hours back in 2020, if that COBRA period, you know, included that April 1st to September 30th period. The one thing you have to watch out here for are penalties. There are penalties for employers that fail to provide notice to former employees who were, you know, allowed to stop making these payments. And the notice date, the deadline for making that notice was May 30th. So if you have clients who haven't done that yet, make sure they do it as quickly as possible to minimize those penalties. The other thing to watch out for is there's also a penalty on the former employee to notify their employer that if they have received another job or have, you know, health coverage through other means or through Medicare or anything like that, those former employees are also supposed to notify their employer that they no longer need the COBRA coverage, and they, you know, because otherwise, if they just stopped paying it, there's no way to tell why they were stopping paying it, right? So, so you just want to make sure that that all the proper notifications are made to both employees and former employers. For education, again, these aren't necessarily things that were part of the American Rescue Plan, although that last one is. The Consolidated Appropriations Act eliminated the tuition and fees deduction, and it didn't eliminate it so much as it didn't extend it. So the tuition and fees deduction is no longer available to taxpayers. The replacement for that is basically an increase in the lifetime learning credits, so that both the lifetime learning credit and the American Opportunity Tax Credit, or as you may have noted previously, the HOPE credit, those two credits have the same qualifications for it, same income phase outs, the same amount. The one thing that did come from the American Rescue Plan is an exclusion for student loan forgiveness from 2021 through 2025. The reason that's important is, prior to this legislation, there were only specified reasons why a forgiven student loan could be excluded from income, and they were basically, if the student died or was permanently disabled or was employed in certain professions, certain service professions. What this piece of legislation did, with this expansion did, was it allowed for the exclusion of forgiven student loan debt for any reason at all, including if President Biden decides that he's going to eliminate $50,000 worth of student loans for everybody who has them, right? Like, there's a lot of people, there's a lot of lawmakers, a lot of Democratic lawmakers who are really pushing hard for that. But it's not even just for that reason. President Biden recently, or the Department of Education recently, eliminated student loan debt for people who I think went to ITT or one of those for-profit colleges. There's been a lot of movement around that as well. So, something to keep an eye on if you have clients who have student loan debt, or who have children who have student loan debt, things like that. It's something to keep an eye on. The last thing I have here are flexible spending accounts. Again, those have been expanded a lot over the last couple of years through the spring legislation last year, and then there were some changes made by Consolidated Appropriations and the American Rescue Plan. It applies to both health and dependent care FSAs. Unused amounts from 2021 are allowed to be rolled over to 2022. Previously it was only a portion, or they were only rolled over to expenses through like mid-March or mid-April or something like that. That kind of changed over the years. And again, like Mark said about the dependent care plans, the employer also has to have these things in place. The one other thing that the change is that you can make prospective changes in the middle of 2021. Normally, you can only decide how much you're putting in your FSA during the enrollment period, usually at the end of the prior year, or a couple months before the plan year begins. But you can make changes mid-year for 2021. So something else to keep an eye on. And now I think we hand it over to Mark to talk about paycheck protection programs.
Thank you, Michael. Let's go back just a second.
One here. There we go.
Okay. So as I'm sure you're all aware of the sort of the fiasco with Paycheck Protection Program expenses. The IRS initially took the position that they were not deductible under the general concept that if the amount is not taxable, and we're talking about forgiven loans, then the related expenses are not deductible. But then Congress said that was not their intent, and enacted following legislation that clarified that these expenses should be allowed as a deduction. So the IRS relented and allowed them as a deduction. But of course, this is all happening after the fact. So people had already applied for the PPP loans, sort of assuming that they might not be deductible, and that probably influenced what they allocated to the PPP loan in terms of salary versus rent or utilities, that sort of thing. So now the IRS has relented, and those expenses are deductible, and the change was made in time for a lot of people to do that on their 2020 returns. But the IRS did in RevProc 2021-20 say that if you filed a 2020 tax return before December 27th, 2020, you are allowed to claim that those expenses on your 2021 tax return, but only for those people. And you because it's now deductible whether the loan is forgiven or not. You no longer need to wait for a determination of forgiveness to deduct the expenses, because now it's deductible regardless whether it's forgiven or not. However, some taxpayers were interested in going back and saying, well, maybe I would have allocated rent and utilities instead of salary if I had known about the deduction. But you cannot go back and change what you allocated to the PPP loan. You're sort of stuck with that, but the expenses are deductible in any event. And I think, Luis, it's time for our next polling question.
That's correct, Mark. Let me go ahead and launch our third polling question of the day. And that was the wrong question. Let me go ahead and get to it. Here we go. The third polling question is, which of the following is not a correct statement about Paycheck Protection Program expenses? First option is the IRS reversed its position and allowed the deduction of expenses for forgiven PPP loans after congressional legislation. Option B, some taxpayers may be able to deduct 2020 PPP expenses in 2021. Option C, the borrower's tax basis in the assets subject to the forgiven PPP loan will not be reduced. And option D, taxpayers must await a determination on the forgiveness of the PPP loan to deduct the related expenses. So answer to the best of your ability. Again, these are not right or wrong answers in terms of receiving your IRS CE credits and your CPE credits. Is simply a way to keep you awake and to make sure that you are still attentive and participating in the presentation, as it is the requirement for the credits. So we'll give everybody maybe 20 more seconds and then close the poll, share the results out with everybody. I know, Mark, this is maybe a little bit more of a harder question than usual, and we'll provide some feedback on the answers and perhaps why some people may confuse some of the responses here, because I'm seeing 50% looking at the option D, taxpayers must await a determination on the forgiveness of the PPP loan to deduct related expenses, but then following closely with 33%, option C, the borrower's tax basis, and then option A, 17%. So let me go ahead and close the poll. We'll share the results out with everybody. You'll, of course, provide the right answer, and then maybe mark some feedback on why there is, perhaps, some confusion with the answers here.
Well, sure. Well, most people got it right. So taxpayers must now await, do not have to await now the determination on PPP forgiveness. That was an issue when the IRS took the position that they were not deductible. So you had to make sure that they weren't forgiven before you could deduct it. But now with they're deductible whether they're forgiven or not, so you do not have to await that determination. So that's the incorrect statement. So the borrower's tax basis in the asset will not be reduced. That was another clarification included in the change, allowing the deduction of the expenses, just to make sure that there was no side detriment to the taxpayers that would affect the basis. And then the IRS did reverse its position. They had said initially that they would not allow the deduction of expenses, and then when Congress enacted the law saying expenses were specifically deductible, they changed their mind. So pretty good job there with people. So it is a confusing question, though.
It is, but it's a fun one because tax law in general, especially when it comes in new, it's somewhat confusing. There's a lot of information going back and forth. So it's great to attend these types of presentations to bring some clarity to the new tax law.
Okay, let's continue on now with some more changes and the getting in as we did with the PPP expenses. We're getting in a little more to some of the business issues now. So paid sick and family leave has been with us since this is one of the first things enacted in 2020 with respect to a response to COVID. It's been extended a couple different times now. So first it was extended through March 2021, and now with the American Rescue Plan, it's been extended through September 30, 2021. The dollar limit was increased to $12,000 from it should be from $10,000. Self-employed days increased to 60 days from 50 days, and also it's a 10-day period that was allowed, but they're allowing a reset, a start over in the number of days allowed after March 31. So even if you used up 10 days in 2020, there's a possible another 10-day period available now in 2021. And also an expansion on the organizations that qualify for paid sick and family leave. So on the whole, a better benefit that continues on through 2021 with some enhancements. The employee retention credit similarly has gotten similar extensions. It was first went through December 31, 2020. Then it got extended through June 30, 2021, and now with the American Rescue Plan, it's been extended for the entire year. I guess one also on the employee retention credit, back on the Consolidated Appropriations Act, that's the one that extended it to July 1, 2021. It also did some enhancements to it, increasing the percentage from 50 to 70%, increasing the per employee limitation, and including also public universities and government hospitals as eligible employers. So there were some enhancements at the end of last year, and then the extension finally to December 31, 2021. Now, one issue with both of these, the paid sick and family leave credit and the employee retention credit, is these credits are all claimed through various forms, but the one way is filing of the Form 941 returns. And one problem is that due to COVID, the IRS has been delayed in processing Form 941 returns. So a lot of the refunds that businesses were hoping to get in a timely manner to assist with COVID issues in their businesses have in many cases been delayed because of the delay in IRS processing of some of these returns. So that's if it just permitted you to reduce the amount you had to turn in with the 941, then maybe you weren't too adversely affected. But if you actually needed a refund, then probably you've had to wait longer than you anticipated for that refund. The deferral of employees' portion of payroll tax. This is the item that President Trump did by executive action last year. It was initially a deferral period September 1 through December 31, 2020, with a repayment obligation in the first quarter of 2021. So a lot of employers, I think, took a pass on this, thinking, helping out their employees for the last quarter of 2020, and then hitting them with a sort of a cut to their paychecks in the first quarter of 2021 didn't seem to be too attractive an idea. So I think a lot of employers passed on this. The federal government administrative branch did adopt it, so those employees at least are affected by it. But now under the more recent legislation, they have extended that repayment period through December 31, 2021 to help out the employees that are affected. But my understanding is that relatively few few employers took advantage of this option. But if you have clients that did, now there is a longer time for the employees to repay and less hit to their paychecks. This one is called the return of the 3 martini lunch. So the business deduction has been established at 100% from 50% if provided by a restaurant, and it includes food and beverages. And this one is for both 21 and 2022. And this does not have to be on premises of the restaurant. It can also apply to takeout and delivery, but it's primarily designed to help out the restaurant. So you can't go to your local grocery store and get the meals for your employees at that lunch. It only applies if it's provided by a restaurant. But again, 100% deduction for 2021 and 2022. The low income housing credit. This is I don't know how many of you are dealing with low income housing, but the change in the rate credit floor, it's now set at 44% for 2021. And I'm actually not sure if this one was permanent or not, but at least it's in effect for 2021, I know. And Michael, I'll turn it back to you for some discussion of some other things that potentially impact 2021 and future years.
Thank you, Mark. So let's go back a second. Sorry about that. There we go. So, you know, this is the regularly expiring tax provisions. You might remember these from, you know, years and years ago. There used to be something like 40 to 50 of them. Every couple of years, they'd get thrown in with legislation at the end of the year, or, you know, sometimes, you know, at the end of the year after it expired. And, you know, it was always kind of a headache. Over the last couple of years, they've made some of them permanent, and they've extended some of them out. Instead of 2 years, they've extended out 5 years. Things like that. So now there are about 17, or there are 17 of them remaining. These are, you know, the big one I think on the list here is the mortgage insurance premiums, treating that as qualified residence interest. You know, that was included way back during the housing crisis back in 2008. It's been included in there. You know, the crazy thing about these is, you know, there's no suggestion or proposal from anybody to include these right now. They weren't in the Green Book. They haven't been in any of President Biden's you know, plans or anything like that. They just tend to get tossed in at the end, you know what I mean? So the one thing that I would point out on here is a lot of those energy credits, specifically the vehicle energy credits, while the Biden administration hasn't been proposing extending these specifically, they have made a huge push on promoting alternative fuels, electric vehicles, things like that. So there are proposals in the Green Book that for, you know, expanded credits on, you know, fuel cells or, you know, charging operations or charging stations, things like that. So I wouldn't be surprised to see some of those things get added in. They tend to be pretty popular from a, you know, from a standpoint of appearing green, and I'm not entirely sure that many people take that much advantage of them. So, but you know, I wouldn't be surprised to see a lot of those energy credits get included in any potential legislation coming down the line. Otherwise, from a proposed legislation standpoint, I'm going to run through this pretty quick. There was a lot of news. There was news just yesterday on the infrastructure deal. President Biden promoted this as the American Jobs Plan. It included a lot of classic infrastructure stuff like highways, bridges, you know, public transit, things like that. A lot of what has been called human infrastructure, which is schools, job training, healthcare, things like that. When the president proposed it, it was over $2 trillion. That was back in early April. In the time since then, there's been a lot of news about a bipartisan deal that was made between a group of about 20 senators and the White House. There was a procedural vote on that yesterday that failed, and it was expected to fail. I mean, Senate Majority Leader Schumer kind of put it out there to, spur negotiation. That said, there is a lot of talk that the infrastructure deal will have that same procedural vote next week, and it will pass because has been a lot of movement on negotiations. For a tax standpoint, there isn't going to be any significant tax. There was talk about increased IRS enforcement in there, but that appears to have been dropped from any of the proposals, any of the deals. There may be some excise tax changes, some tweaks to fuel tax or tire tax or road taxes, things like that. But I would be surprised to see any tax of any great significance to be in there. Other than that, so there's also the reconciliation bill. A lot of the Democrats in the Senate are pushing hard to pass this reconciliation bill, kind of in tandem with the bipartisan infrastructure deal. It remains to be seen what's going to be in there. The expectation is that it's going to include a lot of that, what I referred to before as human infrastructure in there. So a lot of stuff for schools, stuff for job training, things like that. And it also is likely to include a lot of the big tax changes that the president pushed for while he was campaigning. That's an increase in the top rate, increasing the capital gains tax rate, that an extension of, like we were talking about earlier, an extension of a lot of those credits beyond 2021. Because it's going to use the reconciliation process, they'll only get one bite at this apple, and it's got to be passed as part of a budget reconciliation bill. They haven't even passed a budget resolution yet for 2022. Schumer wanted to pass that before they left for the August recess, in addition to an infrastructure bill. So it's not clear yet if that's going to happen or not. It's possible we will see this reconciliation bill in the fall. Remember, they have to pass a budget bill by the end of September. It usually gets extended a couple times. So, anytime from September through December, it's possible we'll see a big reconciliation bill. The rules are different. You only need a simple majority in the Senate, and since the Democrats only have 50 people in the Senate, they would need to use the reconciliation process to get anything if there's any VOP resistance to it. The last thing to keep an eye on for this year is Secure Act 2.0. The Secure Act was passed, I think, at the end of 2018. This is a bill meant to make funding retirement planning easier. A lot of stuff in there about automatic enrollment or more simple enrollment procedures for small employers, things like that. It is wildly popular on a bipartisan level, and it's been sitting around for about a year. I've been waiting for this thing to just get dropped into every piece of legislation that has passed since last July. So I would expect that to pop in somewhere along the line. It might get included in the reconciliation bill if that comes to pass in the fall, or it could just pass on its own too. It's really, really popular on both sides of the aisle. So we'll see what happens there. And I think that's it.
That's right, Michael. Thank you so much for all the content, and Mark, you as well. We do have some questions in the Q&A, so as you look at some of them to see which ones we can answer live, I'd like to take a moment here to speak about the GetWise virtual training for 2021. Those of you using ATX and TaxWise, you're familiar with our annual GetWise training, with a lot more tax updates in the fall and then late in December with our 3-hour tax law updates session. It is a virtual event, meaning no in-person activities this year as we've had in the past, but you can see that it is a it is a simu-live event in that it simulates what an in-person event could be, with interactions, visiting booths, networking with your Wolters Kluwer team experts. And there's a lot of content this year in terms of sessions on the tax software training, as well as sessions on taxation topics. As I mentioned, we do have our December tax law updates. It's a 3-hour class that gives you everything that you need to know leading up to the beginning of the tax season the following year. But before that December session, we have self-study classes that you can join starting October 1st on tax software training. And then we have our big event, October 27th through October 29th. We're joining the CCH Connections User Conference, and that will be a 3-day event where we're going to talk about more tax topics, more tax training. We have special keynote speakers. Overall, a great event and a lot of CE and CPE credits. So as you can see here at the bottom, we have up to 20 CE credits, up to 29 CPE credits. So definitely a great value for your training needs, and to make sure that you have all the information and all the knowledge that you need for the coming year. So just in summary, registration right now is running on an early bird discount basis, so that saves you 20% from the regular pricing. You have access to self-study sessions 24/7 starting October 1st. It's exclusive training for ATX and TaxWise customers, so that means we'll have a lot of tax software training. We have keynote sessions, we have a lot of tax law updates, we have ethics. So basically you're all-in-one training for preparation for the beginning of tax season in 2022. So I'm going to launch our last polling question for today before we go into the Q&A. And that polling question is, of course, are you interested in learning more about GetWise? We can have somebody give you a call. I will send you a follow-up email with more information. Again, right now we have the 20% off the early bird pricing. Retail is $279, so with the 20% off, I believe we're looking at $220, somewhere in that range, which for 29 CPE and 20 CE is definitely a great value. So I'll leave the polling question up here for a couple of more seconds, let you answer, and then we'll move into the live Q&A. I know we have some answers submitted through the session. If you have any more questions that need answers, go ahead and submit them in the Q&A. Michael and Mark are reviewing some of those, and we'll be addressing some of them live here in the next couple of minutes. All right, let me go ahead and close the poll. And Michael, Mark, do we have any questions that we need to address live here for everybody to hear the answer?
Sure, Luis. There are several questions about the child tax credit, so let me just run through some of those. Do you know if it's best to opt out of the monthly child credit and just get the lump sum in the next tax year? Well, I think everyone likes to get money sooner rather than later, and the advance payment credit is an ability to get money sooner rather than later. And the administration is predicting it will significantly reduce child poverty if you get these advance payments. There is the risk, though, that if you have clients that like to get a refund and are used to getting a refund and maybe even rely on getting that refund, if you get these advance payments and spend them and then don't get as much refund next year because you've already gotten half of your child tax credit, although the child tax credit itself is increasing and is fully refundable, there may be some risk that your refund will be lower next year. But I think it's.
If I added on that too, on something, Mark, that's something that that concerns me that I haven't seen talked about a lot. Is I mean, it is increased, but previously it was $2,000. It was increased to at best $3,600, right?
Right.
If you like you said, if you calculate your withholding based on that $2,000, I mean, if you're right there on the edge from of getting a refund every year, if you get $100 refund every year, that's going to flip if you get the advance. I mean, because half of even 3,600 is 1,800, right? So it's going to flip, and I don't think people are I haven't seen a lot talking about that. I've seen a lot of talk about people whose income have increased, so maybe they aren't entitled to as much of a child tax credit based on their 2021 income than their 2020. But you know, it's a little chancy, I think. So I mean, it's a case by case basis. You have to take a look at it.
And that relates to this next question. Will these monthly advance payments be taxable on their 2021 tax year? Well, in a sense, they will be if you end up on your return in 2021 not being entitled to them. You aren't going to get that. You're not going to get the full credit, or you may even have to repay something you've got. So you could not only have a reduced refund, you could actually owe money, as you say. So they're not taxable unless you end up not being entitled to them, but that is a risk. So.
And there is there's a hold harmless provision, but it's really only for very low income taxpayers. I mean, it's basically for people whose kids may have aged out or whatever, or you know, if it's one parent's claiming them 1 year and then it goes to the other parent the next year. But it's low income.
And I think it's only up to 2002 or something like that.
Exactly. So I mean, you really gotta be careful with this, I think.
And how will they receive these payments? Well, the preferred method is the direct deposit if the IRS has the information to do the direct deposit, just because that gets it to you quicker. If the IRS thinks you're entitled to the advance payments, but they don't have direct deposit information, they're going to send a check, but those probably take a little longer. So that IRS portal I talked about does have a place to give the it's called a non-filer tool, a place to give direct deposit information, or if you're a filer, if you go to the IRS portal, there's a place to put your direct deposit information if the IRS doesn't already have the correct information. Will there be forms? Yeah.
No, go ahead.
Okay. Will there be forms that they need to fill out prior to receiving the payments? Well, if the IRS has your 2020 return, no. If they have your 2019 return, no. If they have the non-filer tool that you use to get the economic income payments, no. But if they don't have any of those things, then you are going to have to fill out a non-filer tool for the advanced child tax credit payments to let the IRS know what you're entitled to. So a lot of people will have to do nothing, but if they don't normally have to file a return and they haven't filled out a non-filer tool in the past, then they probably have to do something to get the payments.
And if you are advising your clients to go to that portal, just prepare them for a difficult road, because that portal is not user friendly.
And it's not complete either. They're still adding to it. So
yeah, I mean, I just tried it out myself for my 9-year-old, and there were a lot of hoops to jump through before you could get to actually doing something. So
and I guess we're a little over time. Let me just this one other question: does the business meal deduction apply to Schedule C businesses also? The answer to that is yes. So.
Here's a page for you to go look GetWise for the fall and the December tax law updates. A lot of content information there. As always, if you need to contact your account manager, they're available. So I'll leave this screen up here for the next couple of minutes. We'll stay in the Q&A. Mark, Michael, thank you once again for participating today, and thank you everybody for joining us.